If you make over $161,000 as a single filer or $240,000 as a married couple, the IRS says you can't contribute directly to a Roth IRA. And if you've ever looked into this and thought, well, I guess that account isn't for me, the IRS would love for you to think that. Because there's a completely legal workaround that's been sitting in the tax code since 2010, used by high earners every single year. It's called the Backdoor Roth, and here's exactly how it works. First, why does the Roth IRA even matter? Unlike a traditional IRA, a Roth IRA grows completely tax-free. You contribute after-tax money, it compounds for decades, and when you withdraw it in retirement, no taxes. No required minimum distributions at 73, no tax on gains. For someone in a high tax bracket today who expects to be in a high bracket in retirement, which most high earners do, this is one of the most powerful accounts in the tax code. The income limit is the only thing keeping most people out. The income limits for 2024, single filers start phasing out at $146,000 and are completely ineligible above $161,000. Married filing jointly phases out between $230,000 and $240,000. But here's what the IRS never removed. There is no income limit on converting a traditional IRA to a Roth IRA. There is also no income limit on contributing to a non-deductible traditional IRA. Put those two facts together and you have the Backdoor Roth, a legal two-step that bypasses the contribution limit entirely. Here's the actual process, step by step. Step 1. Contribute to a traditional IRA, but do not deduct it on your taxes. You're making a non-deductible contribution. You've already paid tax on this money. In 2024, the limit is $7,000 per person, $8,000 if you're 50 or older. Step 2. Convert that traditional IRA to a Roth IRA. Do this quickly, ideally within days. The conversion is a taxable event only on gains, and if you just put the money in, there are essentially no gains to tax. Now here's the trap that catches people, the pro-rata rule. If you have any pre-tax money sitting in a traditional IRA anywhere, a rollover IRA from an old 401k, for example, the IRS doesn't let you just convert the after-tax portion cleanly. It treats all your IRA money as one pool. If you have $93,000 in pre-tax IRA money and you add $7,000 after tax, then convert $7,000, you owe tax on 93% of that conversion. The pro-rata rule kills the backdoor benefit if you're not aware of it. The solution to the pro-rata trap is rolling your pre-tax IRA money into your current employer's 401k before you execute the backdoor Roth. Most 401k plans accept incoming rollovers. If yours does, move the pre-tax IRA money in. That removes it from the pro-rata calculation. Then do the backdoor Roth with a clean, zero-balance traditional IRA. Not everyone's 401k accepts rollovers, but it's worth checking. This is genuinely the step that makes or breaks the strategy. The Mega Backdoor Roth is the turbo version, and it's available to people whose 401k plans allow after-tax contributions. Some 401k plans let you contribute up to the IRS annual limit of $69,000 in 2024, not just the employee deferral limit of $23,000. The gap, up to $46,000, can sometimes be made in after-tax contributions and then converted to Roth either within the plan or rolled out to a Roth IRA. This is how tech workers at companies like Amazon and Microsoft have been quietly building massive Roth balances. You need to file IRS Form 8606 every year you make a non-deductible IRA contribution. This form tracks your after-tax basis. It's your proof that you already paid tax on this money, so you don't get taxed again on withdrawal. If you fail to file it, you could be taxed twice. Most tax software handles this automatically, but if you're using a CPA, explicitly tell them you did a backdoor Roth. Some CPAs don't ask, and it's your money on the line if the paperwork isn't right. If you're a couple, both spouses can each do a backdoor Roth. That's $14,000 per year going into tax-free growth every year. Over 20 years at 8% average returns, $14,000 per year becomes roughly $686,000 completely tax-free in retirement. The people who consistently execute this strategy and start early are the ones who retire with accounts the IRS can no longer touch. It's not a loophole that's going away. Congress has tried to close it and failed. The backdoor Roth is one of the most powerful legal tax strategies available to high earners, and most people in the income range that qualifies have never heard of it. 2 steps, $7,000 per person, done every year. If you want to understand the other side of the equation, the HSA, which has a triple tax advantage that even the backdoor Roth doesn't match, our video on the HSA, the triple tax advantage account, nobody talks about, covers exactly why that account pairs perfectly with this one.